Understanding the intricacies of manufacturing finance is not just for the bean counters. It's essential for everyone involved in the manufacturing process, from the shop floor to the executive suite. Today, I want to delve into a crucial aspect of this world: the role of manufacturing cost accountants, the importance of cost of goods sold, COGS, and how these elements tie into gross margin and overall profitability. If you've ever wondered how companies manage to keep their costs down while maximizing their profits, you're in the right place. Let's start with COGS. It stands for cost of goods sold, and it's a critical metric that indicates how efficiently a company is managing its production costs. Think of COGS as the direct cost tied to the production of the goods sold by a company. This includes everything from raw materials to labor directly involved in manufacturing. A well-managed COGS can signal effective cost control, which is often music to the ears of investors and stakeholders. They want to see a company that knows how to keep its production costs in check, because that usually translates to higher profit margins. Now, let's talk about gross margin. This is where things get really interesting. Gross margin is calculated by taking total revenue and subtracting COGS, then dividing that number by total revenue to get a percentage. This metric is like a snapshot of a company's basic profitability. It tells you how much money is left over after accounting for the direct cost of making the goods. This leftover cash is what companies use to cover other operating expenses like marketing, research, and administration. So, if a company has a strong gross margin, it's a good sign that it's managing its costs effectively and can invest in growth. But what happens if that gross margin starts to decline? Well, that could indicate a couple of things. It might mean that production costs are creeping up, or maybe the company is having to lower its prices to stay competitive. Either way, a declining gross margin is a red flag that needs to be addressed. On the flip side, if the gross margin is improving, it could mean that the company has implemented successful cost control measures or pricing strategies. This is where manufacturing cost accountants come into play. Their role is multifaceted and goes far beyond just crunching numbers. They are the gatekeepers of financial information in manufacturing settings. One of their primary responsibilities is to calculate the various types of manufacturing costs, which generally fall into three main categories: raw materials, labor, and overhead costs. Let's break that down a bit. Raw materials are the building blocks of any product. A manufacturing cost accountant needs to work closely with procurement departments to understand pricing structures, discount opportunities, and even currency exchange rates, especially if materials are sourced internationally. It's a complex dance, but it's crucial for keeping those costs down. Then there's labor costs. It's not just about tallying up hourly wages. It's also about benefits, insurance, and sometimes the cost of training. With the nuances of labor laws and union agreements, calculating labor costs can be a tricky business. But getting it right is essential for understanding the true cost of production. And let's not forget about overhead costs. These are the indirect costs that are essential for production, but can't be traced directly to a specific product. Think utilities, rent for the manufacturing facility, and machinery depreciation. Accurately allocating these overhead costs to individual products is vital for determining the true cost of each item produced. Once all these costs are calculated, the next step for manufacturing cost accountants is to assign these costs to individual products and inventory. This is crucial for ensuring that the recorded value of inventory is accurate, which is important for internal assessments and external financial reporting. There are various methodologies for cost assignment, including first in, first out, FIFO, last in, first out, LIFO, weighted average cost, and specific identification. Each method has its implications on financial metrics like COGS and gross margin, so the choice of methodology needs careful consideration. But the role of manufacturing cost accountants doesn't stop at basic calculations. They also dive into performance metrics and variance analysis, which provide deeper insights into operational strengths and weaknesses. Key performance metrics, like efficiency ratios, return on investment, inventory turnover, order fulfillment cycle time, and scrap rates are all within their purview. These metrics help evaluate how effectively resources are utilized and where improvements can be made. Variance analysis is another critical area. It compares actual outcomes against planned or standard costs, helping to explain discrepancies. For instance, if the actual cost of materials is significantly higher than expected, it could indicate issues with suppliers or internal waste. Similarly, labor variances can reveal inefficiencies or the need for training programs. By conducting these analyses, manufacturing cost accountants can diagnose the health of current operations and provide actionable insights for future planning. Now, let's pivot to the strategic aspect of their role. Manufacturing cost accountants are not just number crunchers. They are strategic partners within an organization. They collaborate with various departments, including procurement, human resources, production, sales, and research and development. This collaboration is essential for making informed decisions that affect the entire business. For example, by providing accurate cost structures, they assist sales and marketing teams in setting profitable yet competitive pricing strategies. Their influence extends to high-level decision-making as well. Through data-driven insights, they can help shape product pricing, initiate cost control measures, evaluate capital investments, and contribute to long-term business strategies. Their input is invaluable for budgeting and forecasting, as they rely on historical data and current operational metrics to prepare realistic and achievable budgets. Let's not overlook the importance of advanced cost allocation methods. As businesses grow and operations become more complex, traditional costing methods may not suffice. Advanced methods like job order costing and activity-based costing, ABC, provide a more nuanced understanding of costs. Job order costing is particularly useful for companies that handle a variety of products, allowing for detailed tracking of costs associated with each job. On the other hand, ABC breaks down indirect costs into activities, assigning costs based on actual consumption. This level of detail supports better strategic planning and cost management. Compliance with accounting standards like GAAP and IFRS is another critical aspect of a manufacturing cost accountant's role. These standards ensure that financial transactions are recorded and reported consistently, enhancing the credibility of financial statements. In many jurisdictions, adherence to these standards is legally mandated, making compliance crucial for businesses operating in the manufacturing sector. And let's not forget about budgeting and forecasting. These are invaluable tools that help manufacturing cost accountants plan for the future. They gather historical data, break down cost into variable and fixed components, and allocate resources efficiently. Accurate forecasting allows companies to anticipate market trends, manage inventory effectively, and make informed decisions about capital investments. Scenario analysis is yet another area where manufacturing cost accountants shine. By running what-if scenarios, they can assess the potential impact of various events on the business. Whether it's supply chain disruptions, currency fluctuations, or regulatory changes, these analyses provide actionable insights that help management make informed decisions. Finally, let's talk about the impact of manufacturing cost accountants on pricing strategy and cash flow management. They play a crucial role in determining product pricing through cost-plus pricing, competitive analysis, and value-based pricing strategies. Their insights also help optimize working capital needs by managing inventory levels and analyzing accounts receivable and payable. In today's fast-paced manufacturing environment, technology and continuous improvement initiatives are vital. Manufacturing cost accountants are at the forefront of this transformation, utilizing ERP systems and modern accounting software to centralize data, automate workflows, and provide real-time reporting. They also engage in lean manufacturing principles to identify waste and optimize processes, fostering a culture of continuous improvement within the organization. In conclusion, the role of manufacturing cost accountants is comprehensive and multidimensional. They are not just accountants, They are strategic partners who influence every facet of a manufacturing organization. From determining precise product costs to shaping strategic decisions and driving operational excellence, their work is vital for the financial health and competitive positioning of a business. So, whether you're an aspiring manufacturing cost accountant or simply someone interested in the world of manufacturing finance, remember that these professionals are the unsung heroes behind the scenes, helping to steer companies toward success in an ever-evolving landscape. If you're looking to level up your manufacturing operations, consider reaching out to experts in the field. Their insights could be the game-changing factor your company needs to optimize costs, improve profitability, and gain a competitive edge. Thank you for tuning in, and don't forget to explore more insightful content on manufacturing and finance.